Welcome back to the Deep Dive. We have a stack of research on the desk today that is, frankly, pretty heavy.
It really is.
It's the weekly market report for the second week of February 2026. I've read through it twice now, and if I had to summarize the feeling I get from these pages, it's not panic exactly. It's more like the lights are flickering.
That's a very evocative way to put it. I think that's right. The data in this week's report is, well, it's signaling a transition.
A transition.
A major one. It's not just numbers on a screen. It's a structural shift in how the global economy functions.
And the authors of the report, they use this metaphor that I really want to start with because it frames everything else we're going to talk about.
Yeah.
They call the current situation a high-stakes game of musical chairs.
It's the perfect metaphor. It really is. I mean, think about the mechanics of that game.
Right.
We have a group of people. They're walking in a circle. There's music playing. Everyone is relaxed. Everyone is moving along. But the central tension of the game is mathematical. It's simple. There are fewer chairs than there are people. Always one fewer chair.
Exactly. And for the last, 20 years? Maybe more. The global economy has been playing this game.
Yeah, that sounds about right.
But for the last 2 decades, the music was loud and, it just never stopped. The music was subsidized credit. It was quantitative easing. QE, yeah. It was the Federal Reserve and other central banks just pumping liquidity into the system. It was easy money. And as long as the money was cheap and flowing, nobody really cared that there weren't enough chairs. You just kept walking. You assumed the music would play forever.
But this report is arguing that the music isn't just fading out, it's stopping.
It's grinding to a halt. And this creates a crisis because as we enter the second week of February 2026, the players are suddenly realizing that the seats are vanishing.
And we need to be really clear about what we mean by a seat here. We aren't talking about furniture.
No, absolutely not. In this context, a seat is safety. It's security. It's a tangible asset. It's something real you can put your hands on.
So give us some examples. What's a seat? Okay. A seat is physical silver in a vault that you control, not a piece of paper that says you own silver. A seat is a corporate job that actually generates profit rather than just burning through venture capital.
A real job, not a subsidized one.
A real job. A seat is a software business model that owns its own data, not one that's dependent on someone else's platform. A seat is a geopolitical alliance based on mutual defense and shared resources, not just paper treaties that can be ignored.
So the thesis is, the music, the paper money, the promises is stopping. And everyone is scrambling for a tangible reality, a real chair that simply doesn't exist in the quantity that's needed.
That is the flight to tangibles. That's the core theme of this entire report. It is a collision between the reflation narrative, the story, the news and politicians tell us that everything is growing and fine.
The economic miracle.
Exactly. A collision between that narrative and the hard wall of reality that's showing up in the data.
Okay, so our mission today is to test that thesis. We're going to go through this report sector by sector: precious metals, the labor market, big tech, and geopolitics, and see if the data actually supports this idea that the chairs are disappearing.
And I'll warn you now, and you listening, the numbers we are going to discuss are not friendly. This isn't a standard business cycle dip. This looks like a structural break.
All right, well, let's dive in. Let's start with what the report calls the physical liquidity vice. We're talking about silver and gold. Now, I consider myself a reasonably informed observer, but looking at these notes on the silver market, there is a disconnect here that I don't quite get my head around.
It's a massive decoupling. And to understand this, we have to get a little technical for a moment about how metals are actually traded. We have to talk about the COMEX.
Okay, break it down for us. The COMEX is the main exchange.
Right. The Commodity Exchange, Incorporated, it's the primary futures market for metals like gold, silver, copper. Now, in a normal, healthy market, the COMEX is a place for speculation and hedging. Meaning, if I buy a silver contract for March delivery, I'm usually not looking to actually take the silver.
You're just betting on the price. You think it's going to go up or down.
Exactly. I'm betting the price will go up. If it does, I sell the contract before it expires, I take my cash profit, and I go buy a boat or something. I do not want a dump truck backing up to my driveway with 5,000 ounces of silver bars.
You need a forklift.
I don't have a forklift, and I certainly don't have a vault. It's a logistical nightmare for an individual.
So in business as usual, almost nobody takes physical delivery of the metal.
Correct. The delivery intensity, that's the technical term for the percentage of contracts that actually result in physical metal moving hands, is usually very, very low. Maybe 5% to 10% on a busy month.
So 90 to 95% of it is just paper trading.
Just paper shuffling back and forth, that's the baseline.
Okay, so that's the normal world. Now, looking at the weekly market report for early February, what are we seeing?
We are seeing an anomaly that, just statistically, it shouldn't be happening. Let's look at the open interest for the March silver delivery contract. That's the total number of active contracts out there.
I have the number right here in the report. It says 429 million ounces of open interest.
Okay, so just let that number sink in. On paper, people have claims to 429 million ounces of silver. Now, let's compare that to the registered inventory in the COMEX vaults.
And registered means what exactly? It's ready to be shipped.
It means the metal is actually there, it's been assayed, it's tagged, and it is available for delivery against a futures contract. It's the for sale pile.
Okay, so the paper claims are 429 million ounces. The for sale pile is, wow, it's 103 million ounces.
Stop and think about that ratio for a second.
That's what, more than 4 to 1?
Over 4 to 1, you have paper claims for 429 million ounces. You have actual deliverable metal for 103 million ounces.
That seems risky. But I guess, hasn't it always been leveraged like this?
It has, to a degree. And usually it works just fine because, as we said, nobody ever asks for the metal. Everyone's happy with the paper. But this is where the musical chairs scenario kicks in hard. The report highlights the delivery intensity for February.
The current month. And this is the smoking gun that the report mentions.
This is it. This is the part that should make everyone pay attention. We are seeing a delivery intensity for February of 98%.
98%? Explain what that means. Does that mean 98% of the people holding contracts for this month are saying, give me the metal?
Essentially, yes. It means the behavior of the market participants has shifted completely, radically. This is no longer a market of speculators betting on price direction.
It's become something else.
It has become a physical allocation mechanism. That's the term the report uses.
Yeah.
The people buying these contracts are using the futures market as a grocery store. They are there to clear the shelves. They want the actual product.
But why? Why suddenly take the physical metal? It's heavy, it's expensive to store, as you said. Why not just keep the paper contract and roll it over?
Because they don't trust the paper anymore. If you believe the music is stopping, if you believe the dollar is losing value or the financial system is unstable, you don't want an IOU from the COMEX. An IOU is a paper chair. Physical silver in your hand is a wooden chair. It's real.
And with that 4 to 1 ratio, if everyone asks for their chair at the same time...
There aren't enough chairs. It's that simple. It's a classic bank run, but for metal. And there is a deadline ticking down that's making everyone very nervous.
The report highlights this date, February 27th.
First notice day for the March contract. That is the moment of truth. That's when holders have to declare if they intend to take delivery.
So what's the risk here?
The risk is that if even, say, 25% or 30% of the March contract holders, the 429 million ounces worth stand for delivery, the COMEX mathematically runs out of silver. They don't have it.
What happens then? Did they just close the doors?
Default. They would likely declare force majeure. It's a legal clause for unforeseeable circumstances. They would tell the contract holders, look, we're sorry, we cannot deliver the metal. Here's a check for the cash equivalent at today's price.
But that completely defeats the purpose. If I'm demanding the metal because I'm worried about the currency, the very last thing I want is more currency.
Exactly. You want the metal because you think the cash is trash. And that is why a cash settlement event would be catastrophic for confidence in the entire system.
How so?
It would prove definitively that the paper price you see on your screen has completely detached from the reality of the physical market. It would signal that the price is fake and the shortage is real, and that repricing would happen violently.
It seems like some people, even at the state level, are seeing this coming. I was reading this section on the domestic response, and I was pretty surprised to see state-level politics getting involved in money.
You're looking at the Florida legislation.
Yeah, House Bill 999.
This is fascinating stuff. Florida is moving to make gold and silver official legal tender and also tax-exempt within the state.
Is this just symbolic? You know, like when a state names an official state bird? Or is there real teeth to this?
The report argues this is a strategic plan B. It's not symbolic at all. You have a major U.S. state government, a huge economy in its own right, looking at the instability of the dollar, looking at these inventory shortages we just discussed, and saying, we need a parallel rail, we need an escape hatch.
So they're building a system for their citizens to use if the main one fails.
They are building a mechanism for their citizens to transact in real money, in tangible assets, if the Federal Reserve note faces a crisis of confidence.
That is a profound vote of no confidence in the federal system. I mean, that's the state basically saying, we don't trust you.
It is. It's a state government securing its own chairs because they don't trust the music coming from Washington anymore.
Wow. Okay, so that's the physical asset market, the stuff you can hold. But most of our listeners, they aren't buying silver bars on the COMEX. They're working jobs. They're paying mortgages. Let's pivot to the economic seat, the labor and banking section in the report.
And this is where the abstract concept of musical chairs becomes a very painful, very immediate reality for families.
The report makes a comparison here that, honestly, it made me sit up straight. It compares February 2026 to the onset of the Great Recession in 2009.
It's a heavy comparison to make, but the data, unfortunately, supports it. We are seeing seats jobs being pulled from the workforce at a rate we have not seen in nearly 2 decades.
Let's get into the hard numbers. January 2026 layoffs. What are we looking at?
We're looking at 108,000 layoff notices in a single month.
108,000. Now, context is key here. Is that just a bad month, or is this part of a trend?
It represents a 205% increase from December.
Whoa.
That is not a seasonal fluctuation. That's not a holiday hangover. That is a collapse in employee retention. But the layoff number, as bad as it is only half the story.
Right. You have to look at the other side of the equation. Hiring.
Exactly. Are new chairs being put into the room?
And the report says hiring announcements hit a 17-year low.
A 17-year low. Only 5,300 new roles were planned across all the tracked sectors. Now, think about that ratio for a second.
108,000 people let go. 5,300 new spots opening up.
It's brutal math.
That is the absolute definition of musical chairs. You stand up, you turn around, your seat is gone, and there are almost no other empty seats in the entire room.
Precisely. And the way companies are executing these reductions is shifting, too. It's becoming much more calculated. Colder.
The HSBC story you pointed out.
Yes, the zero bonus policy.
Walk us through this, because to an outsider, hearing that some bankers didn't get a bonus might not sound like the world's biggest tragedy.
And it's not about sympathy for bankers. It's about understanding the strategy. It's a signal. In high finance, particularly in investment banking and trading, your base salary is often just a retainer. The bonus is your actual income.
So your bonus can be what, double your salary? More?
Easily. So if you cut the bonus to zero for underperformers, you are effectively cutting that employee's total compensation by 40, 50, maybe even 60% overnight.
So why not just fire them and be done with it?
Because firing thousands of people is expensive. You have to pay severance packages, you risk wrongful termination lawsuits, and you generate terrible PR. HSBC fires 5,000 people is a bad headline that spooks the market. But if you just cut their pay in half,
Good quit.
they quit voluntarily. It's a soft layoff or a constructive dismissal. It's an aggressive tactic to thin the herd without paying the costs or taking the public relations hit.
It feels incredibly ruthless.
It is ruthless. But what it signals is that the banking sector, which has better real-time data on the health of the economy than almost anyone else, is moving from growth mode to margin protection mode. They are battening down the hatches. They see a storm coming.
But wait a minute. This is the part that drives me crazy. If I turn on the news or I listen to the White House press secretary, they are talking about an American economic miracle. They're citing these incredible GDP growth figures. Why is there such a massive gap between the official story and this data?
The report has a great term for this. It calls it narrative divergence.
That's a very polite way of saying gaslighting, isn't it?
You could say that. It's a divergence between lagging indicators and leading indicators. GDP is a lagging indicator. It looks backward. It tells you what happened 3 months ago.
And it can be manipulated.
It can be heavily influenced, let's say, especially by government deficit spending. If the government borrows $1 trillion and spends it on projects, GDP goes up by $1 trillion. But that doesn't mean the organic private economy is healthy at all.
So where do we look for the truth? What are the leading indicators telling us?
You look at the things that tell you what is going to happen next. And the report specifically points to the transportation sector.
Trucks, trains, planes, the stuff that moves things around.
The absolute bloodstream of the economy. If people are buying things, if factories are making things, those things have to move from point A to point B. It's that simple.
And the report highlights major layoffs at UPS and Amazon.
Which is so critical. Think about it. Amazon and UPS are the ultimate barometers of consumer demand. If they are laying off tens of thousands of drivers and warehouse workers, it means one thing and one thing only. Box volume is down.
It means people aren't clicking buy now.
Exactly. The consumer is tapped out. They're struggling with inflation, with debt. The physical movement of goods is contracting sharply. That is the reality on the ground, regardless of what a government spreadsheet says about last quarter's GDP.
So we have the physical commodity market breaking, we have the labor market freezing up. But surely technology is the lifeboat. We've been told for 3 years straight that AI is the boom, the future, the savior of the economy.
Well, this is where the report gets really, really interesting and maybe a little terrifying for anyone working in the software industry. They titled this next section, Technology's Seat Compression.
Seat compression. I feel like I know where this is going, and it's not good.
It's the next phase of the musical chairs game. And to understand it, you have to look at how the software industry has made its money for the last 15 years. It's all been about the SaaS model, software as a service.
Right. You pay a monthly or annual subscription. Salesforce, Slack, Zoom, Microsoft Office, Adobe, everything.
And how is it priced? What's the unit of value?
It's usually per user, per month.
Per seat. That is the key phrase. The entire valuation of the trillion-dollar software industry is built on the simple idea that companies will hire more humans every year.
It's a tax on headcount.
It's a direct tax on corporate headcount. If a company grows from 100 employees to 500 employees, Salesforce makes 5 times the money. Their revenue is directly tied to human job growth.
Okay, I see the setup.
But now, we are seeing a fundamental shift in AI. We are moving rapidly from AI assistance tools that help a human do their job faster to AI agents.
What's the distinction there? An assistant versus an agent?
An assistant helps you write an email better. An agent is the employee. It reads the incoming email, understands the request, accesses the database, formulates a response, and sends the email. It handles the customer service ticket from start to finish.
Without the human in the loop.
Without the human. So let's just run the math on that. If I'm a CEO, and I can deploy an AI agent that does the work of 5 customer service reps, or 5 paralegals, or 5 junior accountants.
You don't need the 5 reps anymore. You fire them.
And here's the kicker for the software market. When you fire the humans, you cancel their software licenses. You cancel their 5 seats for Salesforce, their 5 seats for Microsoft 365, their 5 seats for Slack.
Oh, wow. I hadn't connected those dots. You don't buy a Salesforce seat for an AI agent.
No. The AI interacts with the database directly through an API, often for fractions of a penny per transaction. It doesn't need a graphical user interface. It doesn't need a seat.
So the AI revolution is actually a massive deflationary bomb aimed directly at the heart of the software industry's business model.
It's a revenue cliff. The report estimates that if AI allows companies to operate with 60 or even 80% fewer humans in certain roles, the total addressable market for per-seat software collapses by 60 to 80%.
That completely destroys the valuations. I mean, these companies are priced for infinite growth, not a market that's about to shrink by 2/3.
It's a valuation crisis in the making. It's a massive be careful what you wish for moment. The tech giants spent billions of dollars building the very technology that is now poised to dismantle their own most profitable business model.
So if you're an investor or just someone trying to understand where the value is actually going, if the seat model is dead, where is the safe chair in the tech world?
The report says Wall Street is already making the move. They are aggressively rotating capital out of what they call AI dependence and into companies with data moats.
Okay, define data moat for us.
A data moat is a proprietary data set that is scarce, unique, and absolutely necessary for training powerful AI models.
Give me an example.
Okay, think about medical records. If a company has exclusive access to 50 years of longitudinal heart surgery data, the procedures, the patient outcomes, the imaging, that is a deep, wide moat.
Because an AI can't just invent that.
It cannot hallucinate that data. It cannot scrape it from the open internet because it's private and protected by high pay, but it needs that data to learn how to diagnose heart conditions or assist in surgery.
So the AI is the engine, but the data is the fuel.
Exactly. The AI models themselves are becoming commoditized. The code is becoming abundant. But the fuel, the unique, scarce data, is where the real value lies. If you own the fuel, you have all the leverage. You have a seat that can't be taken away by automation.
It's fascinating how this theme keeps coming back to scarcity. It's the same pattern everywhere. In the silver market, the paper promises are becoming worthless because they are abundant. The physical metal is valuable because it's scarce.
And in tech, the software code is becoming abundant and cheap. The unique data is scarce and valuable.
That is the synthesis. Scarcity is the only real hedge against a system that is designed to print infinity.
That's it.
Which brings us to the biggest stage of all, geopolitics. Because if this game of musical chairs is happening in the stock market and the job market, it's definitely happening between nations.
Oh, absolutely. The report calls this section the end of unipolarity. The global power structure, which is, the ultimate seating chart, is being rearranged in real time.
And it starts, interestingly, with a cultural signal, with the media.
The resignation of Washington Post CEO Will Lewis.
Which happened right after those massive newsroom layoffs we saw earlier this year.
And look, it's sad to see these great institutions crumble, but the report frames it as a symbol. The Washington Post was a legacy seat. It was a seat of power, of influence. For decades, it controlled the narrative.
But in the new information landscape.
That seat has been pulled out from under them. The audience has moved. The trust has evaporated. It's a casualty of this massive shift from centralized to decentralized information.
But the stakes here get much, much higher than just newspapers. We're talking about NATO. We're talking about the bedrock of the Western alliance.
The report identifies a developing NATO fault line. And interestingly, it centers on resources again. It always comes back to tangible things, specifically Greenland and the Arctic.
Why there? Is it just about territory and military bases?
It's about what's under the territory. Rare earth minerals, which are critical for all modern technology. Huge reserves of oil and natural gas. And as the polar ice melts, new, much shorter shipping lanes are opening up. It's some of the most strategic real estate on planet Earth right now.
And there is a conflict brewing over who gets to control it.
A major one. The report suggests the transatlantic alliance is nearing a breaking point over these resource issues and over who should pay to defend them. The scenarios outlined are quite dramatic. They talk about a potential fracture where Western Europe, feeling abandoned by the U.S. or just seeing their interests diverge, pivots toward creating a French-led nuclear core.
So basically, Western Europe deciding to build its own military deterrent and look out for itself.
Exactly. While Eastern Europe is left to act as a kind of buffer state against Russia, the idea of one big, happy, unified Western family is dissolving. The seats at the global power table are being moved around.
And then there is Germany. This was the stat in the whole report that made my jaw drop. Germany is supposed to be the bedrock industrial ally of the U.S., but the money says they are leaving the party.
Always follow the capital. Germany is facing a crisis of deindustrialization. Their energy costs, post-Nord Stream, are cripplingly high. Their factories are struggling. They're in a desperate position, so look at their investment flows.
The report says Germany slashed its investment in the U.S. by 45%.
Almost cut in half. That is a massive withdrawal of confidence in the future of the U.S. economy.
And where did they put that money instead?
They increased their investment in China by 55%.
That is a pivot. That's not a small adjustment. That is a massive strategic realignment. They are looking at the U.S. economy and saying, we aren't sure about you. They're looking at China and saying, we need access to that market to survive.
Yeah. And there was one other detail about Germany that connects right back to our very first segment about silver. The gold.
Yes, this is so important. German lawmakers are now openly calling for the physical repatriation of their national gold reserves.
A lot of countries keep their gold in vaults in New York or London, right? The New York Fed holds gold for dozens of nations. It's just been the way things are done.
Historically, yes. It was about trust and ease of trading. It was easier to settle accounts if the gold was already in a central location. But when you ask for your gold back, when you say, put it on a plane and fly it to Frankfurt, that sends a very, very specific message.
It says, I don't trust you to hold this for me anymore. It says that, and it also says you want to eliminate counterparty risk. They want the physical asset in their own vault, under their own control, just like the traders on the COMEX want the physical silver in their own hands.
It's the exact same pattern. Whether you're a day trader in Chicago or you're the German government, everyone is rushing to grab the actual physical asset before the music stops for good.
Precisely. Counterparty risk, which is just a fancy term for the risk that the other guy won't pay up or that the rules will suddenly change, is becoming the #1 fear in the entire world.
Now, usually when we talk about escaping the system, escaping the dollar, escaping counterparty risk, people in our audience will shout one word, Bitcoin.
And this is where the report delivers a pretty harsh reality check for the crypto faithful.
Yeah, the section is titled Bitcoin's Identity Crisis. I imagine this won't be popular with some of our listeners, but we have to look at the data for this week.
We have to. And the data for the second week of February 2026 is unambiguous. Bitcoin has plummeted below the $70,000 psychological mark.
But it's not just the price drop, right?
Yeah.
I mean, crypto is volatile. We all know that. It's how it's trading that's the issue.
Exactly. The whole thesis for Bitcoin, the digital gold narrative, is that it's supposed to be a safe haven. It's an uncorrelated asset. If the banking system looks shaky or the geopolitical situation gets tense, Bitcoin should go up.
But it's not.
It's doing the exact opposite. The report specifically mentions aggressive institutional selling on platforms like Coinbase.
And a persistent negative premium. Explain what that means.
It means the big players, the institutions, the hedge funds are selling into any strength. And crucially, they are treating Bitcoin as high beta risk-on slop.
Ouch. Slop. That is not the terminology the crypto community wants to hear.
It's harsh, but from a professional trader's perspective, it just describes an asset that correlates tightly with the most speculative tech stocks. When the Nasdaq falls, Bitcoin falls even harder. That makes it a risk asset, not a store of value or a safe haven.
So in this game of musical chairs, at this specific moment in time, Bitcoin looks more like a paper chair than a wooden one.
Right now, yes, the market is treating it as a speculative tech play, not as a safety raft. That could change, but that's what's happening now.
And a lot of this pressure on crypto, on stocks, on everything is coming from the mothership, from the Federal Reserve. We have a new sheriff in town.
The Warsh shock. That's what the market is calling it.
Kevin Warsh, the new Fed chair.
And his appointment changes the rules of the game completely. Warsh is known for being an orthodox monetarist. He is not a fan of the printing money solves everything school of thought that has dominated for the last 15 years.
The punch bowl is definitely being taken away. The party's over.
His appointment signals a massive liquidity drain, a reversal of QE. The report estimates his stated policies could withdraw as much as $7 trillion from the global financial system over the next couple of years.
$7 trillion with a T. That is the sound of the music stopping.
That is the deafening silence after the music stops. That is the vacuum. When you pull that much money out of the system that quickly, asset prices have to come down. The paper wealth that was created by all that printing simply evaporates.
So let's try to pull this all together. We've covered a lot of ground here. We've got metals, jobs, tech, geopolitics, the Fed. What is the grand synthesis here? What's the one big takeaway?
The synthesis is that the reflation narrative is dead. The idea that we can just print our way out of debt, that technology will magically solve our solvency issues, that the world will remain a happy, stable, unipolar place. It's all colliding with a very hard reality.
And the reaction from individuals, from corporations, and from nations alike is a desperate flight to tangibles.
Look at the pattern again. It's the same in every single sector we discussed.
Laid it out.
In silver, paper contracts are being abandoned in favor of physical metal.
Per-seat software licenses are becoming less valuable than proprietary scarce data.
Paper alliances are proving less reliable than repatriated physical gold.
So capital is seeking shelter.
It is seeking assets that cannot be printed, cannot be deleted, and cannot be deplatformed. That is the new three-part criteria for safety. If a government can print it, or a tech company can delete it, or a platform can ban you from it, it's not a safe seat.
That is a very sobering realization. So for you listening, trying to navigate this week, the report has some specific action items, things we should all be watching.
Yes, 3 main things. First, mark your calendar for February 27th.
The silver delivery deadline on the COMEX.
Watch that like a hawk. If we see a failure to deliver or a massive spike in cash settlements, that is the canary in the coal mine. It will tell you the physical shortage is real and systemic, and it could trigger a repricing across all commodities.
Okay, number 2.
Check your portfolio for what the report calls seat risk. Look at the tech companies you own. What is their business model? Are they selling seats to humans? If so, they are structurally vulnerable to AI-driven job compression. It's a massive headwind that isn't going away.
And third,
watch the gold window. Keep an eye on the news out of Germany and even states like Florida. These movements of sovereign gold and the legislative push for sound money are the ultimate signals that the U.S. dollar's global dominance is being actively rejected.
it's a lot to digest. But I think that musical chairs image is going to stick with me.
Yeah.
It's a terrifying metaphor, but it clarifies things immensely.
It asks a very simple, very fundamental question.
And that is the question we want to leave you with today. We've laid out the board. We've shown you the data. The music is stopping. The seats are disappearing.
Because you have to look at your own life, look at your portfolio, your career, your assets, your savings.
And ask yourself, are you sitting in a paper chair? Something that exists only as a digital promise, a line in a database, something that can vanish with a click of a mouse or a change in policy.
Or are you sitting in a tangible chair, something you actually own, that you control, that you can hold in your hand?
Because when the music stops for good, only the tangible chairs will remain.
Something to think about.
Thanks for diving deep with us. We'll see you next time.
Stay safe out there.